Hi, this MindMap from ThinkingAudit focuses on the changes to the UK Corporate Governance Code. The code was published in July 2018 by the Financial Reporting Council, the FRC, and the MindMap draws out some of the changes in the latest code, but given the restructure of the code as well as new requirements, it's not practical to cover everything, so this is what I consider to be the highlights. The UK Corporate Governance Code really is the latest in a succession of guidance and expectations for companies. And while the code is there for companies with a premium listing on the London Stock Exchange, such guidance has always been seen and used by other sectors as a benchmark for good governance. Many other sectors will base their governance requirements on what's in this code. And the first change that we'll notice is the structure of the new code. So I stepped away from the structure of a mind map very briefly, but I think it was useful to set out the changes. The structure of the 2018 code is simplified. To me, this works much better. Now we have just principles and provisions, and with a new structure in terms of 5 sections over which the code is based. This latest version of the code is effective for accounting periods starting on or after the 1st of January 2019. And the areas that struck me when reading this as significant changes really were about focus on the long term, moving away from short-termism. It's stronger on managing conflicts of interest. There's a lot of additional content around the remuneration committee, and throughout there is a focus on organisational culture. And lastly, one area I found particularly interesting was that the code recognises the risk of overboarding. That is, board members having too many appointments to be able to give their appropriate time and focus to that particular role in the company. And when reading or applying the Corporate Governance Code, you should really be reading other guidance from the FRC, and I think in particular the guidance on board effectiveness, as it supports implementation and interpretation of the code. The timing of the code's publication also coincides with the UK government having just updated the Companies Act through the Companies Miscellaneous Reporting Regulations 2018. Next, I'm going to take a look at the changes that stood out to me, and I've decided to group these by section of the code, although some themes do overlap between sections. The drive on culture comes through strongly in the code, and while engagement with shareholders is not new, there is definitely a renewed emphasis on engagement with other key stakeholders, including the workforce. Guidance on board effectiveness says that companies with a clear purpose often find it easiest to engage their workforce, and that they have a clearer understanding of intangible sources of value to their company, such as the skills of the workforce, and therefore what's relevant to the performance of the company. So an interesting theme here, we're definitely seeing a push about engagement, culture understanding, and how that does support the performance of a company. And lastly in this section, the code does now go further than previously regarding taking action to identify and manage conflicts of interest. There are 2 areas of particular interest with regard to division of responsibilities. Firstly, that focus on overboarding. Boards must consider the other demands on directors' time when they're appointing to the board. I think something that's come out for a number of recent company failures, and the observation that some non-executive directors have a really significant portfolio of such appointments. How are they able to give sufficient time to each role? The code also says full-time executive directors shouldn't take on more than 1 non-executive directorship in a FTSE 100 company or another significant appointment. Secondly, we come to the roles of the chair and chief executive, and the code is very clear that the roles of chair and chief executive should not be exercised by the same individual. The chief executive also should not become chair of that same company. However, the code, I think, is being quite pragmatic, and it does recognise that such instances will happen, because it goes on to say that when those circumstances do happen, major shareholders must be consulted ahead of the appointment, and that board should publish reasons to shareholders for that appointment being made. We move on now to composition, succession and evaluation. And the aspect of the consultation on the code that was most controversial was probably that around the tenure of chairs. Provision 19 sets out a 9-year tenure, but it is pragmatic again. It recognises that boards will need to plan for effective succession, and therefore sometimes that tenure can be extended, particularly if the chair was already a non-executive on the board before becoming the chair. And I know some businesses and respondents to the FRC's consultation were worried that this 9-year rule could mean too much churn of non-executives all at once, so I think this pragmatic approach should help. On first read through, the section of the code focusing on audit, risk and internal control is not significantly changed. There are a few points of interest. Firstly, the wording around having an internal audit function has been strengthened, although having an internal audit is still not a formal requirement. Regarding the external auditor, Provision 25 now says that the audit committee should conduct the tender process, rather than just being consulted on the tender process for the external auditor. And then the role of the board and the audit committee is really emphasised with regard to the company's principal risks and reporting on those. Provision 28 sets out a requirement that the board should carry out robust assessment of the company's emerging and principal risks. And, as previously, describe these in the annual report. The major change here is the focus on emerging risks, not just principal risks. I think the code recognises that the role of a remuneration committee can be a challenging one, in that it expects anyone chairing a committee should have been a member of such a committee, not necessarily in that company, for at least 1 year previously. The committee should now also have oversight of workforce remuneration policies, again making that link with organisational culture. It should also have responsibility for setting remuneration for senior management, not just the executive directors in terms of the executive side of the company. Director pay has continued to be a focus in the media, and at times apparently taking priority over organisational performance. This is reflected in the fact that the code now sets a principle for directors to exercise independent judgment and discretion when authorising remuneration. I think the focus here is on ensuring there's real transparency and business need behind remuneration decisions. Linked to that, the provision relating to remuneration schemes for executive directors has been amended. It's been amended to promote longer-term shareholdings to align, I guess, with shareholder longer-term views and interests. So share awards granted should be released on a phased basis, and the vesting and holding period now should be 5 years. It was previously just 3 years. An important point as well to note about remuneration is that while the code comes into effect for accounting periods on or after 1st of January 2019, if a company is planning a new remuneration policy in 2019, it really should be doing it with this code in mind. Thank you for watching this latest mind map. You can download it from the Thinking Audit website, and as ever, I'd love to hear your feedback and ideas for future topics.